Very good morning, everyone. How are you? All good? Audio video all set? Very good morning. Let me know. No issues with audio and video? Audible and visible. All right. So, welcome to the Financial Stability Report. You were waiting for a long period of time, right? So, now onwards, we will be covering the FSR report, which is much awaited by you all. I'm also good. So here we are with the first lecture of Financial Stability Report. Very important document for all of you for the exam. So we will try complete it comprehensively with focus on each and every trend, fact, as well as relevant concepts. So whatever concepts are written here will be cleared so that you are able to remember all these things, remember all these facts, and then interconnect and remember the trend as well. Okay. All right. So अभी तक तो यही रिपोर्ट इंपॉर्टेंट है other than the RBI annual report and this FSR. All right. Now, so you know that this is the 29th edition of Financial Stability Report, right? So here we have the PDF Financial Stability Report June 2024. So it is the 29th edition, as you all know, 29th edition. 29th edition of the report. Now, there is a general introduction about the report at first instance. So, the Financial Stability Report is a half-yearly publication, as you know, right? It is a half-yearly publication, right? So, it is published half-yearly, and this one is the 29th edition with contributions from all financial sector regulators. So, remember, a general introduction about the report. Okay. So, this is 29th edition, published half yearly, and then it has contributions from all your financial sector regulators. That's why it is a very comprehensive document, you know. So what do we mean by when we say that all financial regulators have contributed to it? So contributions from, you know, your IRDAI, contributions from all your sectors which are related to your regulators related to your financial sector. So it is a comprehensive report giving you the trend of each and every sector of the financial market. Are you getting my point, right? So remember this thing. Then it presents the collective assessment of the subcommittee of the Financial Stability and Development Council. So it is prepared by whom? Tell me quickly. It is prepared by whom? So the collective assessment is done by, yes, quick responses please. Subcommittee of FSDC, right? Subcommittee of FSDC. FSDC is what? Financial Stability and Development Council. So you know what Financial Stability and Development Council is. Financial Stability and Development Council is an organized apex level body of government of India, which was established with an aim of promoting financial stability in India, monitoring all these things related to financial stability, then monitoring the interoperability of all these regulators, right? Ensuring coordination among all these regulators. Final aim is achieving financial stability, macroeconomic stability, macro-financial stability, and ultimate economic growth, right? So tell me, who is the chairperson of this committee, subcommittee of FSDC? Who is the chairperson of subcommittee of FSDC? Who chairs the subcommittee of FSDC? I am not asking the chairperson of FSDC, I am asking chairperson of subcommittee of FSDC. So FSDC is chaired by Finance Minister, but who chairs the subcommittee? There is a difference, yes, that's why I am asking you, right? RBI Governor. So remember, FSDC chaired by Finance Minister, but the subcommittee of the FSDC chaired by RBI Governor. Remember the difference, okay? Both the chairpersons are different. Also, one more thing you should keep in mind, that FSDC is not a statutory body, okay? FSDC, the Financial Stability and Development Council, is not a statutory body, neither constitutional, not statutory, right? It is just, it was just created by notification. So, it is not statutory. It has not been created by statute or by law of the parliament, right? Understood, everyone? So, this is the thing. This is not statutory. Now you have this report. This was general introduction about the FSDC, about the subcommittee of the FSDC, and about the report. Yeah, not by any statute or law. Okay. So this is clear to all of you. Now let's begin the analysis of the report. So we have chapter 1. We have chapter 1. Chapter 1 is titled as, chapter 1 is your macro-financial risks. Macro-financial risks. Now this analysis and the report is going to be a bit technical, but you need not worry about that. You just take out a pen and paper, write down all the concepts which we will be discussing in this report, so that you are handy with all the concepts. When you revise them, you are able to retain the trend and the facts related to them. Are you getting my point? So sit down with a pen and paper and write down all these concepts which are coming during the analysis. So first chapter which we have is macro financial risks. Here the report gives you the idea of what has been the macro financial risks, right? So at the global economy, first we will look the macro financial risks at the global economy or at the global level, right? So we will have global scenario as well as the national scenario of the report. At the global level, what has been the risks in the financial markets, macro financial risks, what have been there, right? So there are certain indicators. Now first thing, we are assessing it at the global level. So this report says that at the global level, the global financial system, they have remained resilient. Global financial system have remained resilient. So, you can draw parallels between RBI annual report and this report. There will be many facts which will coincide, because recently we have covered the RBI annual report as well. So you know what has been the performance of these macroeconomic and financial indicators, isn't it? You are not unaware about them. You are well aware about them. So it would be easy for you to understand these trends. So at the global level, the global financial system is resilient enough. It is not performing very poor. This is something which we have discussed already, right? So global level pay, financial system has remained resilient and financial conditions stable. Financial conditions are stable. So this report is saying financial conditions, all these indicators, we will do all the indicators. You will understand on what basis are we saying, are we concluding that this has been towards a stability trend. We will do all those indicators, macro financial. Okay. So it has been stable despite an uncertain and challenging backdrop marked by last mile disinflation process, elevated public debt, geopolitical tensions, and economic fragmentation. Now what the report is saying, try to understand that overall view is at the global level, financial systems, financial indicators are showing resilience. And there is a stability, okay? There is not much volatility, there is somewhat stability despite some uncertainties and challenges, okay? Despite an uncertain and challenging backdrop. Now what is this uncertain and challenging backdrop which is happening at the global level? You all know that there are some phenomena going on. There are certain geopolitical tensions going on at the global level. What am I talking about, right? So you have the Middle East tensions, you have the Russia-Ukraine war. All these geopolitical tensions are going on. This is something related to geopolitics. But at the economic level as well, or at the financial level as well, there are certain macroeconomic indicators like disinflation processes. They are in their last phases, which we call as last mile disinflation. These are certain challenges which are still hanging over the performance of your macro financial markets or financial markets at the global level. These are the risks. So you should understand that, okay, this is the trend. Note it down that generally the financial market is, financial performance at the global level is resilient. It is stable, but simultaneously there are certain challenges going on. What are these? So last mile disinflation process. Now you all know what is disinflation, isn't it? Tell me quickly, what is disinflation? I have told you the difference between all these terminologies in the RBI annual report class only. What is disinflation? I'm expecting quick responses from you. What is disinflation? Lesser inflation, right? So you know there is a difference between deflation and disinflation. Disinflation, okay, very good. So disinflation is when you are trying to lower the rate of inflation. It is not deflation, right? Deflation is when the general prices, they fall. So it is opposite of inflation. Deflation is opposite of inflation, but disinflation is where, yes, where you have inflation but at a decreasing rate. So if you can connect the dots with the RBI report, just connect the dots. We have seen that at the global level, there is a rising inflationary trend. That's why you see at the global level, the major central banks or the central banks of the advanced economies, which includes your Federal Reserve as well, have withstood the withdrawal of accommodation stance, right? So tight monetary policy is being practiced by all these central banks to contain the inflation within the desirable limits because the rates are higher. So at the global level, all the central banks are trying to reduce the rate of inflation. So this is on the backdrop of this challenge, you know, last mile disinflation process. Why is this a challenge? What is last mile? Last mile here is referring to the last phase, that we are in the last stages or phases of disinflation process. Why is this still a challenge? Because we still have not been able to contain the inflation within the desirable limits, right? Be it at the national level or be it at the global level. Okay. All right. So this is the thing. Then elevated public debt. Next challenge which you have is elevated public debt. One thing, if you remember the RBI annual report classes, we have discussed that at the global level, public debt is very higher and they have higher fiscal deficits as well. We have seen the example of USA. We have seen the example of China, isn't it? Also, I would request you to please focus on the class. You can discuss all these things in those discussions with sir, or you can, if you have any queries, you can mail him regarding that. Okay. Please focus on this lecture. It is a bit technical. If you don't understand the concepts, that would be difficult for you to remember the trend and the facts in that case. Okay. So second challenge is elevated public debt. So at the global level, if you remember, the RBI annual report also says these advanced economies, they are having higher debt levels, right? So that is also a challenge because then they have higher fiscal deficit. And when you have higher fiscal deficit, it affects even your financial market. This is something which we have seen in the yesterday's editorial class as well, right? So this is a challenge. Next, geopolitical tensions, as we have discussed. Next, economic fragmentation. Economic fragmentation. There are certain regions of the world, so you know, global north and global south, as we say. There are certain advanced economies. There are certain economies which are in process of emerging markets. They are actively engaged in the global value chains. There are certain developing economies. This economic fragmentation is there. All these, given all these challenges, which I hope you have understood, still at the global, you are able to witness somewhat resilience and stability in the financial conditions. This is the first trend highlighted by the report. Is this clear to everyone? Yes, India is an emerging market and a developing economy as well, right? You have understood till this point, right? Now, next thing, against this backdrop, the International Monetary Fund has projected global growth to remain steady at 3.2% in 2024 as in 2023. Now, given this scenario, what the growth projections of IMF are? Let's see. So, IMF, International Monetary Fund, has given a growth forecast. According to IMF, the global growth has to remain steady. So, not much fluctuation is expected. They are expecting it to remain steady at how much percentage? At 3.2 in 2024. At 3.2 in 2024. Okay. All right. Next, the World Bank, on the other hand, projects the global growth to be lower at 2.6 in 2024. So we are talking about 2024, which is the ongoing current year, right? Now you have two forecasts in this case. First is given by IMF, second is given by your World Bank. Okay, so the IMF forecast is a bit higher than the World Bank one. You see, IMF says that the growth would be at around 3.2%. Okay, 3.2% in 2024. But the World Bank forecast is lower than this. So World Bank is saying that it would be around 2.6 in 2024. 2.6 in 2024. So remember these figures. These are important for you. Remember these figures. Okay. The growth forecast, you know, you get these direct questions on the trend based questions basically. So these are the authentic sources. What is the growth forecast as per World Bank? What is the growth forecast as per IMF? World Bank 2.6, IMF 3.2 for 2024. All right. Now, if you see this chart, if you see this graph, so this chart has been provided in the report. It becomes interesting when you have these charts, isn't it? Otherwise, the PDF looks boring. Okay. So, you see this chart 1.1 global growth forecast. So, this is by IMF, this is by your IMF, and this is by your World Bank. World Bank. Now, you see at the global level, this is green color, sea green type. Okay. So, at the global level, you see IMF has this forecast. So, it has been steady. Why are we saying it has been steady? You look at this bar graph. It is in 2022, then 2023, then 2024, and then 2025. Okay. So, across all these financial years, you see green one is your global growth forecast. It has remained almost stable, 3.5, 3.2, 3.2, 3.2. So, what we are expecting is also 3.2%. 3.2%. Okay. Are you able to analyze this graph? So, do it along with me. It would be helpful for you, right? Next, you see this one. Color might be different in your, you might be seeing different color in the video, but it is green. Okay. And then you have peach color for the advanced economies. Now, this is the advanced economies forecast. This is not very stable, but also not very fluctuating. You see 2.6, 1.6, 1.7, 1.8. Then for emerging market and developing economies, you see 4.1, 4.3, 4.2 and 4.2. So for emerging market and developing economies, the growth forecasts are higher than the global average. It means what? That emerging market and developing economies will be growing faster than the global average. If you are able to understand this graph, yes or no? Everyone, have you understood this this graph? So this is the trend, stability. So it is steady projection, right? Understood? Okay. So this is the projection by IMF. Yes, it is higher for EMDs. Okay. Then you have the growth forecast, the chart given by the World Bank. In World Bank, you see again green color is for the global one. Green color is for the global trend. So you see at the global level it is 3, 2.6, 2.6. But for advanced economies, so as you have seen, what the World Bank predicts for the global level is around 2.6. So this is 2.6. 2.6 in 2024. 2.6% in 2024. Right? Again here you see blue one is EMDs. Emerging market and developing economies, EMDs. So the blue bar graphs are representing the EMDs. Again, the growth forecast or projection for these emerging market and developing economies is much higher than the global average, as well as compared to the yellow ones, which are your advanced economies. Right? So this is a general trend which you should notice, that emerging market and developing economies are projected to be growing at a faster rate than the global projected growth rate. Are these both the graphs are something you have understood? Everything regarding these graphs, these charts? I hope you have understood, right? So this is the trend. Remember, emerging market and developing economies, higher growth projections they have, okay, given by World Bank as well as the IMF. So this is the initial growth projection part at the global level. So we have seen one part of the macro financial risk, which is global economy. Now you are very much clear about the global economy. What you have to remember is these percentage numbers given by the World Bank as well as by the IMF, right? Now next thing which you have is Indian economy. Indian economy. So Indian economy, when we talk about what are these conditions, what are macro financial risks related to Indian economy. Now we are not talking at the global level, we are talking at the Indian level. So let's see what does the report has to say regarding Indian economy. Indian economy. In this uncertain international economic and financial environment, Indian economy is exhibiting resilience and remains the fastest growing major economy. Now you already know by the RBI annual report that despite all these uncertainties at the global level, be it geopolitical tensions, be it rising inflation, be it rising fiscal deficit, rising public debt, despite all these scenarios going on at the global level, Indian economy has been very much resilient recently. Isn't it? Our macroeconomic and financial indicators are performing very well. Very well. Okay. So despite all these international uncertainties, we have been able to be one of the fastest growing major economy in the world. Fastest growing major economy in the world. Okay. Yeah, these data will help you in every examination. While writing your descriptive, you need to authenticate your argument so you can quote that this data according to the World Bank is this. Okay. Now, moreover, India's contribution to global growth is rising and currently stands at 18.5% in 2023-2024. Are you getting my point? Try to focus on this analysis. You can have these discussions after the class as well. What am I requesting you again and again? To focus on the analysis of the report. It is a bit technical. Okay. So, moreover, India's contribution to global growth is rising. Now, you see, this is something congratulatory on the part of Indian economy, that despite international uncertainties at the global economic level, you have Indian economy's contribution to the global GDP or global growth continuously rising for a good period of time. It is still rising. So in 2023-2024, India's contribution to global growth has stood, at 18.5%, 18.5%, which is not low. Okay, that is good. That shows that your economy is performing well. It will also boost investors' confidence, so you will be able to attract capital. Inflow of capital, right? Inflow of investments, funds, foreign funds as well. So this is good indicator. Next thing, if we talk about the real GDP growth, it is on a rising trajectory supported by macroeconomic and financial stability. So another important thing is real GDP growth. Now real GDP is rising. That is very satisfactory. Why am I saying that? Because we have seen the difference between nominal GDP and real GDP. I have told you that nominal GDP can rise due to actual increase in the output in the economy. Also due to rise in the current price level or the general price level. Because nominal GDP is calculated how? So you have P into Q as GDP. In nominal GDP calculation, you have prices of the current year, right? So rise in the figures of nominal GDP can be due to inflation or cannot be. Right? But in real GDP, you have price taken from the base year. Isn't it? What is the base year for real GDP calculation in India presently? What is the base year for real GDP calculation in India? Tell me. Present base year. So here the prices are fixed. Whatever changes is due to change in quantity broadly. Okay. Prices are not reflecting the current inflation. So it is inflation adjusted. Very good. 11-12. Yes, 2011-12. So in real GDP is inflation adjusted, right? If it is rising, it is reflective of actual economic output increasing in your economy, production activities and production of goods and services rising in your economy, which is necessary for growth. So it is real indicator. It is real indicator of economic growth, right? So if real GDP is rising, it is on a rising trajectory, supported by macroeconomic and financial stability. That is a good sign for our economy. That is a good sign for our economy. You should remember this. Now, talking about the next thing, you see, inflation. If we talk about the inflation, it is moderating, although with uneven pace. Moderating, but not even pace. So we have discussed in RBI class as well that, tell me, food inflation is rising, but which inflation is moderating in case of India? So your core inflation, isn't it? Core inflation, if you are able to recall from those classes, core inflation in India is moderating, because core inflation does not includes food and fuel items. Very good, right? So when you exclude these items, core inflation you see is moderating, although there is higher retail inflation, higher inflation in terms in food items, but still. So that's why it is written that inflation overall is moderating, but at an uneven pace. So it is not a uniform condition. Inflation in every food item is not something which is moderating, but a general trend is that it is moderating. Yes, but there are certain areas, certain segments in which you have higher inflation, like food inflation. Recently we have covered this. And why food inflation is rising in India? Because of the supply side. So is this inflation demand pull or cost push or bottleneck inflation? Tell me quickly. The present food inflation which India has is primarily driven by demand side inflation or supply side. Yes, it is primarily bottleneck. So because of climate change and all these uncertainties, climate shocks, supply shocks, you are witnessing food inflation in India. Okay, very good. So you remember all those facts. So inflation, general trend about inflation, it is moderating, but at uneven pace. Remember this, not evenly distributed in every segment. Also, fiscal consolidation is underway. What is fiscal consolidation? We have discussed. Fiscal consolidation is when you have prudent fiscal policies. So the government tries to reduce the fiscal deficits and expand its revenue generating sources. So when you focus on generating more receipts, also cutting down or rationalizing your, say, unnecessary expenditure, right? Unnecessary subsidies. So when you try to reduce fiscal deficit and come closer to the fiscal deficit target set by FRBM, that is fiscal consolidation. These policies are underway, and external sector position is also improving. If you remember, current account deficit in India is moderating or expanding? Tell me quickly. Current account deficit in India is expanding or moderating as per RBI annual report? It is contracting. It is moderating or contracting, isn't it? Very good, right? So current account deficit moderating, it means India is also performing well on the external front. So given all these situations, you see Indian economy is very much resilient on inflation front, on fiscal consolidation, on current account deficit or external front. This is the thing. In spite of global spillovers, so this is the strength of Indian economy. In spite of all these global challenges which we have discussed, despite that, we have been able to perform well on all these fronts. So this is, these points are what they are saying. Okay, I hope you have understood. Now, next point which we have in the discussion. Okay, so then the domestic financial system, if we talk about the financial system of Indian economy at very domestic level, so it is well buffered. FSR says that it is well buffered. So you have proper buffer or capital adequacy. This is something which we have already discussed, right? So Indian banks are performing well on their liquidity management front, risk management front, right? It is due to prudent regulation by RBI that we have good amount of buffers to withstand any unprecedented risk arises due to national or international causes. Why? So It is well buffered with strong capital and liquidity ratios, declining levels of asset impairment and rising profitability. When we are saying that domestic financial system is well buffered, on what grounds are we saying that? What evidence do we have? So we are saying that we have enough liquidity in the financial system because of strong capital and liquidity ratios. We have these indicators coming in front of you. You will understand. So they all are performing well. On capital front, you have adequate capital as per the requirement, right? So there is a requirement of capital adequacy ratio. You are maintaining it in a substantial amount. Then if you talk about the liquidity ratios, so banks are also maintaining apt liquidity ratios in India. Okay. Then I'm also talking about other entities which are there in the financial market. Then declining levels of asset impairment. What is this asset impairment? So you see declining ratio of asset impairment, declining levels of asset impairment. What is asset impairment? Asset impairment, any idea? Yes. NPAs. Okay. It is not basically NPA. You see, asset impairment. We are talking about the financial system as a whole, right? So, in financial market, not specifically to the banking terminologies, asset impairment is what? Asset impairment is what? Let me write it down for you. So, also write all these concepts. I have asked you in the initial beginning of the class only. Sit with a pen and paper, okay? Asset impairment. So in financial market, we use this term, asset impairment, when the market value of an asset, is lower or becomes lower than its carrying value, lower than its carrying value. So generally, when the market value of an asset becomes lower than its carrying value, we call it as asset impairment. Now you know what is market value, but then what is carrying value? What is carrying value? So it is nothing but the general cost of the asset which you hold, cost of the asset which you are holding, minus any depreciation which has accumulated on that asset, minus any accumulated depreciation, over that asset. You know what is depreciation, right? With usage, with time, so the value of the asset declines. Okay, so asset impairment is this situation. Now what a healthy asset is, generally for a profitable asset to hold, you should have the market value higher than the carrying value, yes or no? Higher than the carrying value. But when asset impairment happens, so your market value becomes lower than the carrying value, so lower than the cost of the asset. Carrying value is your cost, general cost of the asset, minus if there is any accumulated depreciation, fall in the value of the asset, right? So this is asset impairment. Have you understood this concept? I hope, right? Now moving back to the analysis, you can write these down, or take a screenshot. Okay. Now moving back to the analysis. So here we are saying, or the report is saying, that domestic financial system is well buffered due to strong capital and liquidity ratios, also declining level of asset impairment. Now you understand this, right? So asset impairment in Indian financial market is declining. So less loss on the assets which you hold, isn't it? So this is something also providing resilience to Indian financial market. Declining levels of asset impairment and rising profitability. So the assets which we are holding, these can be your financial market assets. We are also talking about these can be your real estate related assets. So these can be your stocks, these can be your real estate assets, all these assets. So the impairment in these assets is falling and the profitability is rising. That is something providing resilience to Indian financial market. You have noted it down, right? Next thing which we have is India's financial system is bank dominated. India's financial system is bank dominated. Our financial system, our economy is heavily dependent on the resilience of the banking system, and therefore sound health of the banking system is essential for preserving financial stability. This is not something very peculiar. In all my classes, if you remember, I have already told you that for any economy to withstand any crisis, be it national or global, you have to have a sound health of your banking system, isn't it? That's why savings play an important role, if you could connect it. Savings. So when you have enough household savings rising in your economy, they will be converted into deposits via rising financial inclusion, via banking penetration or deposit penetration, and then it translates into investment levels, right? That's why banks should have enough liquidity. Their health is important for your economy's health. Okay. Next, banks' balance sheets are consistently improving. The balance sheet of the bank is consistently improving. What does that mean? So in the balance sheet of the banks, the NPAs which were there at the highest since last decade, they are now reducing. NPA is reducing, and the assets which banks are holding are performing well on their profitability indicators like return on assets, return on equity, all these things. So we are performing well on these profitability indicators, right? We have discussed these profitability indicators in the RBI annual report as well. So that is why we are saying that Indian financial stability is secured because banks' balance sheet are also consistently improving. Less of liability, less of loss, and more performing assets. Okay, then with multi-year low NPA ratios, higher provisioning, stronger capital positions, and robust earnings. Okay. Yes. So why are we saying that banks' balance sheets are consistently improving? So these are the indicators you should substantiate your answers with. First thing, multi-year low non-performing assets. So your non-performing assets, the bad loans, they are declining. Okay, they are declining. With sustained efforts by the Reserve Bank of India, by the Government of India, you are able to witness the fall in the NPA. So NPA falling, first thing. So your stressed assets are reducing. It is improving your balance sheet. Okay. Next thing, higher provisioning. Higher provisioning. What is provisioning? Higher provisioning. What is provisioning? Tell me. These are norms, but norms of what? Okay, so provisioning norms as said by the RBI, they require these banks, to set aside a percentage of their profits, a percentage of their funds, yes, for meeting these risks or liquidity shortages, isn't it? This is provisioning. Now you have different categories in provisioning, different figures are there, different requirements for different type of banks. Also, categories are different for doubtful assets, for lost assets, for all these kind of asset classification. Yes, so these are kept aside out of their profits, out of their funds, for maintaining buffer in order to meet any unprecedented risk, right? But now provisioning norms are, regulated. They are continuously being supervised by the RBI, and you have higher provisioning norms. If you remember, we have discussed for project finances as well, the provisioning has been increased, right? If you remember the editorial, we have discussed for project finance, the provisioning norm has been increased to be realized by 2027, isn't it? So there is something called provisioning. Now, there are certain concepts related to provisioning which I want you to remember. So in provisioning, generally there are two broad categories. Okay, when we talk about provisioning, provisioning for basically risk management, right? So it can be broadly divided into two categories. First is general provisioning, okay? So first thing which you have is general, and the other one is say specialized, okay? So general one is, as the name suggests, it happens ex ante, or it is not due to any NPA which has been accrued, not due to any NPA. Generally you have to maintain certain amount to avert any kind of risk. So in that case you have general provisioning, right? General provisions which you need to maintain. It is not NPA specific, so it is not related to any particular account, or any particular kind of loan which has become NPA. So these are general provisioning norms. Under general provisionings, you remember these happen ex ante, or before the event takes place. So before the NPA, this is precautionary measure. Are you getting my point? Precautionary measure. Okay. So before NPA arises, you should have this much to meet with any crisis like situation or risk whichever comes in. Noted? So ex ante. Now the second one, the specific or the specialized, is related to certain specific accounts. Why? Because they happen, they are kept after NPA happens. So this is ex post. This is ex post. Ex post. After the event happens. Right? This is ex post. Note it down. After the event or after the NPA happens. So these are linked to your NPA accounts. They are kept particularly for the NPAs, whichever loans have become stressed or whichever assets have become stressed, right? So they are account specific. They happen after the event occurs. That's why ex post, and they are general provisions. These are specific provisions. Have you understood this? Okay. Now there is something called as additional provision. Additional provision or floating provisions. Additional provisions or floating. Additional provisions or floating provisions. Now neither general, not to be classified as general or specific, floating provisions are additionally maintained. They are particularly generic in nature or general in nature, but these are additional, maintained apart from these two categories, right? In order to have proper capital adequacy with yourself, to have proper buffer to withstand any kind of financial risk or risk in the banking sector or financial sector. I hope you have understood all these terminologies, everyone. So now you know what is provisioning exactly, right? Okay. Also, the norms which are there, the rates which are there for different categories, like for doubtful assets, in doubtful assets, if these are more than 3 years, you even have to keep 100% of the NPA as provisioning, right? So these categories, different rates which are applicable, how much percentage of provisioning you need to maintain, provision you need to maintain, will be discussed in some of your RBI circulars, okay? Those are not required here. So we will cover them in the RBI circulars only, the top 51, okay? Got it? Now, moving back to the analysis. So that's how you understand that NPAs are low, then you have higher provisioning, you are maintaining general, specific, floating provisions, then you have a stronger capital positions, enough capital you are maintaining, robust earnings. Your earnings, since your profitability is higher, you have higher profitability and less loss. So balance sheet performing well is translating into higher or robust earnings. Now in turn, these developments are catalyzing a broad-based and sustained credit expansion. Now when you have sufficient funds, when you have sufficient capital, it is only then that you can extend credit to a greater level, right? So credit expansion happens when you have proper liquidity buffers only. right? Yesterday only we have discussed this editorial in which we were concerned about this trend that credit growth is outpacing the deposit growth. Is it really a concern for India? Then we have seen the answer of the author that no, it is not, because we have a good range of credit growth and deposit growth, right? So it is not a concern yet, but we need to monitor it. It should not extend for a longer period of time. Okay. No, floating provisions are not for any additional assets. These are, general in nature, additional to all these two categories which I have told you. Okay. I'm not sure about who will take the classes. We will let you know for the RBI circulars, but it will happen. Yes, I am talking about the elevated public debt. Whether it be India or countries, that is also necessary for growth. Yes, that is necessary. But we have discussed in the editorial classes that excessive debt or excessive fiscal deficit is harmful. You know how is it, right? Crowding out and all. So you go to those classes and just see the analysis, you will be able to understand everything. So now we have this thing, a very sound banking system. So when you have good amount of capital, liquidity, less NPA, more profitability, you are able to expand the credit extension in your economy. And when credit expansion is there, investment activities will be spurred. Okay, it will give an uptick or a push to the investment activities. Then there will be growth. So this virtuous cycle will keep on going. Are you able to understand this entire picture, bigger picture, connecting all these concepts with each other, right? Shall I move ahead with this graph? Now it is becoming more technical here. Okay. All right. Now you take out again a fresh page and a pen, write down all these concepts. Now we have this chart provided by the report. Very interesting one. Okay. So banking sector soundness indicators we have. You should be well aware of all these indicators. Okay. Now what all are these? These are your banking sector soundness indicators. These indicators reflect how much sound or how much healthy your banking sector is, right? We will look upon the concepts of all these indicators and then we will look at the trend. You will be able to understand the benefit of the trend only once you understand the concept. So let's see all these indicators. One more thing, try to understand this graph, this chart. This is data provided from 31st March 2015 to March 2024. So this is financial year 15, 17, 19, 21, 23, 24. So this is across 15 to 24 financial years. Okay. Now, first indicator has been provided by the report is your gross advances. Gross advances. What are gross advances? What are gross advances? Gross advances are your total outstanding loans or advances which your banks have. Whatever loans, advances you have made, total outstanding which have not been recovered, okay, is your gross advances. Whatever you have lent and whatever is outstanding, this is your gross advances. Total outstanding loans or advances, basically. Understood? Gross advances. So first indicator is your gross advances. Everyone. Next thing which we have is your gross NPA percentage. Gross NPA percentage. Now, yesterday only we have discussed the difference between gross NPA and net NPA. You remember the difference? Tell me. Do you remember the difference between gross NPA and net NPA? So gross NPA you all know what it is, right? Non-performing assets. When your assets, when the loan which the banks have given or the financial institutions have given, they stop providing you or earning for you, right? So you are not able to earn out of them, basically, in a very simple terminology. What is the difference between gross NPA and net NPA? So in gross NPA, you do not deduct the provisioning which you have done against them, right? So gross NPA includes the provisioning. So it is not a real indicator. Real indicator is net NPA. Net NPA. So you can write down this formula as well if you have forgot this. So when we say gross NPA versus net NPA. So in gross NPA, what is net NPA? Net NPA will be your gross NPA minus provisioning made against them. So net NPA becomes gross NPA minus provisioning made against them. Yes, very good, right? So which is the actual indicator? Net NPA. It actually gives you the assessment of the risk which is accruing to your balance sheets. Isn't it? Because now you have deducted the provisioning which you have made for it, the buffer which you have against these risks. So this is the real indicator, net NPA. Net NPA should fall. Then only we can say that NPA in banking sector is declining and you have lesser risk as compared to the previous levels. Understood everyone, right? So remember the difference. All right. So this was your gross advances. Then you have gross NPAs. Then another indicator which we have, net NPA. So you know what is gross NPA and net NPA now, okay? Then you have ROA, return on assets. Then you have ROA, return on assets. What is return on assets? Return on assets shows the profitability of your assets which you are holding. So whatever assets the banks are holding, the financial institutions are holding, what is the net income they have been generating out of it? Okay, so what will be the formula for this? Return on asset. We have discussed these terminologies in the RBI annual report as well, right? ROA, return on asset. Okay, so what is ROA? It is return on assets, right? Yes, profitability of your assets. But what is the exact formula? Exact formula would be ROA, return on assets. So your profit after tax, profits after tax divided by average total assets, into 100. Okay. So write it down. Give me a second. Have you noted it down? Noted, right? So now you see what is ROA, return on assets. Whatever average total assets you have, you are dividing the profits after tax, that is also after tax. So this is actual profitability being indicated, isn't it, into 100. Now ROA is also performing well. So this is profitability of the assets with the banks or other financial entities are holding, right? Now coming back to the analysis. All right, so now you know what is ROA as well, return on assets. Then you have CRAR. What is CRAR? The capital adequacy requirement, right? What is CRAR? Quickly tell me. CRAR, capital to risk. Tell me the extension of CRAR quickly, everyone. Capital to risk weighted assets ratio. Yes or no? You remember the extension of CRAR? Capital to risk weighted assets ratio. Very good. So CRAR basically shows what? Yes, very good. CRAR shows how much adequate capital do you have against your risky assets, basically, or risk weighted assets, right? How do you calculate them? How do you calculate them? So your total tier 1 plus tier 2 capital divided by your total risk weighted assets, CRAR. Tier 1 plus tier 2 capital divided by your total risk weighted assets. Remember, you remember the formula, right? We have discussed this formula a number of times. CRAR, capital to risk weighted assets ratio. So what basically it shows is, against your risk weighted assets, whatever risky assets you have, how much adequate capital, adequate funds you have. In case they default, in case they default, in case there is a credit event, right? So in that case, you have sufficient buffer to minimize your losses. Okay, minimize your losses. Very good. Tier 1 plus tier 2 capital divided by TRW. So you know what is CRAR is. You have understood its implication as well. Now you have liquidity coverage ratio, LCR. So what is this LCR written over here? LCR is your liquidity coverage ratio. Liquidity coverage ratio. Liquidity coverage ratio. What is LCR? What does LCR shows you? So we have discussed the formula of LCR as well in RBI annual report analysis, if you remember it. Yes, anyone? For your responses. What is LCR? No. LCR and SLR? SLR, you are talking about the statutory liquidity ratio. They are not the same. They are not the same. Okay? भूल गए? Revise नहीं करते हो? हाँ? So liquidity coverage ratio basically shows your, okay, LCR, liquidity coverage ratio. Liquidity coverage ratio. Now you know there is a difference between capital adequacy ratio and liquidity coverage ratio. Yes, very good. It is as per the Basel III guidelines. So you have to have high quality liquid assets. You have to have high quality liquid assets. High quality liquid assets against your total cash outflow for next 30 calendar days, against net cash outflow for next 30 calendar days into 100. So this is your liquidity coverage ratio is. Exactly what liquidity coverage ratio is. Are you getting my point? So this is what we call as liquidity coverage ratio, right? High quality liquid assets divided by your total net cash outflow, which you have to maintain for next 30 days, 30 calendar days into 100. So what does this reflect basically? It reflects your short-term liquidity management requirement. Are you able to manage the liquidity obligations which you have in the short term, because it is only for 30 calendar days, right? LCR. What are high quality liquid assets which can be easily converted and readily converted into cash without any losses? Are you getting my point? High quality liquid assets. High quality liquid assets. They can be easily converted into cash without any losses, right? So you have different categories of them. High quality liquid assets. You have level 1, level 2A, and then level 2B. You need not go in that much depth, but just for your understanding. Okay, tell me quickly, which one will be the highest one? Cash and related assets. Cash will be liquid, yes or no? Your saving accounts, yes or no? right? So this is in decreasing order of liquidity. This is in decreasing order of liquidity. L1 will be most liquid asset, L2A less liquid, and L2B least liquid. Okay, so in L1 generally you have cash, government bonds, all these things, saving accounts, right? L1, highly liquid assets. Then in L2A you have these securities issued by your multilateral banks like Asian Development Bank, Asian Infrastructure Investment Bank, AIIB, ADB, right? AIIB, etc. African Development Bank. So all these multilateral development banks, these securities, they offer L2A. Then L2B, in L2B you have your corporate securities. Generally the securities issued by your corporate market, corporates or corporations, right? So this is the general classification. That's why it is in decreasing order of liquidity, decreasing order of liquidity. This is what LCR is. Understood? So you have to maintain high quality liquid assets for meeting your liquidity obligations for next 30 calendar days. This is what LCR reflects. I hope you have understood this entire concept. Okay. Now moving back to the analysis. So you have LCR here, then you have PCR. Okay. So this is provisioning. PCR is provisioning. PCR. So LCR we have done, then you have PCR. PCR is your provisioning coverage ratio. Provisioning coverage ratio. Provisioning coverage ratio. So provisioning coverage ratio will be what? How much of your gross NPA, are you keeping aside as provisions? Simple. So PCR basically is ratio of gross NPA capped as provisions. Simple. Okay. So understood what is PCR? Provisioning coverage ratio. PCR. So PCR is your ratio of gross NPA which you keep as provision, okay, against your gross NPA. This is your PCR. Understood? Yes or no? Then next you have is slippage. Now what is slippage? So in financial or banking terminologies, this term slippage basically means addition to your NPA. Addition to your NPA. So whatever NPAs are added during an accounting year, during an entire financial year, is your slippage. So whatever addition into your NPA is your slippage. Understood? Right? So NPA, how can you calculate the ratio? So slippage ratio is basically calculated as freshly accruing NPA divided by, so whatever freshly accruing NPAs are there in an entire year divided by your total assets or standard assets which you have at the beginning of the year into 100. Okay. So you can note down the formula of slippage ratio as well. How you calculate it? Freshly accruing NPA accruing in the year divided by standard assets held at the beginning of the year into 100. So then it would be NPA. So this is your slippage ratio. NPA accruing in an year or during an year divided by total standard assets, which are performing well, okay, regular income generating loans or assets, standard assets at the beginning of the year, beginning of this year, okay, beginning of this year into 100. So this is your formula for slippage ratio. Okay, NPA accruing during the year divided by standard assets held at the beginning of the year into 100. So how much addition of NPA is there in the year? This is showed by slippage. Okay. Now you have understood all these concepts. So let's look at the trend. the trend now you will be able to understand, and you will be able to say that yes, India is performing well. Coming back to the analysis. So you have understood all these terminologies. Now tell me quickly. Now tell me, gross advances you see from March 2015 to March 2024. Earlier these were 66.9, then you have 75.9, then 94.6, then 105.3, then 135.2, and 161.1. Is it a better situation or not? Gross advances, is it good? Rising advances are good or not? Because advances are your assets, isn't it? Loans are assets for the bank. So expansion in gross advances, right? Good. Okay. Next, gross NPA. You see the trend of gross NPA now, like this, then like this. So it is falling. So if you see from March 23 to March 24, it has been falling. Again, a good indicator that shows gross NPA are falling in case of India. So less NPA, more better balance sheet. Okay. Then you have net NPA. Net NPA, much better indicator than the gross NPA one. Initially increasing, but then after that, after March 17, you see continuous efforts by the RBI, it has been falling and falling and falling. Now it is only 0.6. Net NPA, yesterday's editorial, remember, we have discussed that they are 0.6, right? And gross NPA are around 2.8, 2.6. So net NPA falling down, again a very much better indicator, isn't it? Right? So performing well on this front. Then you see return on assets. Return on assets. We have seen what is return on assets, profitability of assets. Initially it was good, but then it contracted by March 29 and 2020. Why? This was the phase of the pandemic, you see. Other factors as well. Rising NPA. Okay. So you see at this point of time NPA were rising. So if NPA were rising, they started falling. You analyze them in between these lines, these graphs. So when NPAs were falling, obviously your profitability will reduce, isn't it? Tell me, yes or no? But then after sustained efforts, when your NPA started falling down, you see ROA started increasing or expanding. Now it is 1.3%. So you try to relate them. These are falling down, gross NPA, net NPA, and ROA is increasing. Profitability is increasing, balance sheet performing well, right? This is the thing. Okay, now you are able to understand this chart. Now next thing is CRAR, capital adequacy ratio. So capital adequacy ratio, you see continuously rising. That shows you have enough capital and liquidity to stand by any unforeseen circumstances, right? Next thing which you have is your LCR, liquidity coverage ratio. So liquidity coverage ratio in terms of percentage, 96, 124, 128, 158, now 130. Okay, although increasing, but it has fallen down from the previous level. Okay, we need to focus more on this liquidity coverage ratio. We need to have more high quality liquid assets, although it is on a rising trend. So there is no much concern about it. Understood, everyone? Then you have PCR, provisioning coverage ratio. So provisioning coverage ratio, you see, is continuously rising, 74, and then you have 76. So it has risen from the earlier level as well, previous level as well. From 74, it has risen to 76. It means what? You see, RBI is continuously focusing upon more provisioning, right, to have enough capital adequacy and to reduce the risk which is there in the banking system. Yes, I am going to cover the entire report, of course. As we have covered the RBI annual report, we will cover the financial stability report also. Alright, so this is the thing. Now PCR increasing is also good for the safety net of the banking system, yes or no? Tell me, everyone. Then you have slippage. I have told you what is slippage. So slippage is a terminology used as addition to NPA, what is happening in that year, right? I have told you the ratio formula as well. Now slippage, you see, was rising here when your NPA were rising. See, NPA were rising here, right? So your slippage was expanding from 3.3 to 5.9. But then as and when NPA started falling down, see these lines, as and when NPA started falling down, your slippage started contracting. Slippage started contracting. See this, isn't it? Now it is very less, 1.6. So continuously contracting, since NPA is continuously falling, so slippage is also continuously contracting. Are you able to relate all these performances with each other? Right? So they are not happening in isolation, not operating in isolation. That can be negative as well. Yes, of course, if you have no NPAs, right? But that is ideal situation. India requires a lot more time to reach out to that level. Okay, you tell me, are you able to understand this chart? And everything is related. So slippage is contracting because NPA are falling. So they are not operating in isolation. Explain them in relation to each other. Now you have understood all these concepts. We have seen all these trends. So now we can say that yes, India's financial sector is actually resilient. NPAs are falling. We are performing good on the soundness indicators which are used in the banking system. We are performing good on profitability front as well. ROA increasing, return on assets increasing, right? So we have done, we have completed till this chart. Now I'll be taking up further in the next class. So we will be taking up from this heading, global macro financial risks, okay, elevated debt and all these things, right? So we have completed this chart. Very important, all these terminologies, I hope you have written all these concepts and formulas which I have discussed with you. Okay, now how to make short notes for revision, as all the information RBI annual report say important, PDFs feel bulky. Okay, so you know, you can do one thing, write all the concepts in one notebook or whatever sheets you have. So you just revise the concepts out of it and then write important trends which they ask generally based on the previous year question on one paper. Okay, just write them in shortest form which you can have, or try to draw the graphs. So if you want to explain that ROA is rising, don't write the entire line. You can just write like this, that you know, ROA increasing. So you remember the trend, it is increasing. Okay, just this much would be sufficient. So you reduce your letters, your words, your time, your space, everything. Simple. Okay, right? Any further questions? So we will continue this series. We will continue the analysis. It is a bit technical. Further, with the ending of the report, it is becoming, it is going to become more technical, you know. But I'll try to make it simpler for you as much as possible. That's why I request you, please focus on the class, because while doing these technical analysis, it distracts me if some other relevant questions are asked. Okay. All right. So we will see, we will meet in the next session. I'll see you in the next part, lecture 2 of Financial Stability Report. Till then, revise all these concepts. Make sure that you remember all these trends so that you can write your answers effectively. Okay. Have a good day. See you in the next session. Thank you so much. Thank you so much.